Hey, we're on.
We are,
Yes,
indeed.
we are.
And that jaunty music we had right there means it's time for a little news. I'm not aware of any news today, John. Did something happen?
Yes, something that we don't see very often in these markets. We saw the market, the equities markets, limit down overnight and then reopen and then close for a minute on the next circuit breaker at 7%. So it's something we don't see very often, and I'm sure many of our traders have never seen it, and we want to kind of talk a little bit about what that means.
John, what is a circuit breaker?
Well,
other than something that you got to flip when the lights go out at home.
Yes, right. The circuit breakers were put in the equities futures after the 87 crash. There was nothing to stop price action. There was nothing to help traders kind of calm their minds a little bit. So after the 87 crash, they started putting in these percentage circuit breakers. The circuit breakers are basically limits where the price cannot go below that limit for a certain period of time. As we saw this morning, the 7% circuit breaker closed the market for 15 minutes. Why do they close the market? Well, it gives the market a chance to kind of even out the order flow, right? You may bring some buyers in. It helps people calm their minds and make better trading decisions after they've taken that little bit of a little 15-minute break. Generally, that's the kind of view of it. But
also time for us to all fill our coffee cups.
Yes, and time to get some coffee. Absolutely.
So, hi there, Jay, Nick, Tana, Aloy, Santa, Ellen. Hello, level 2. Welcome to it. So might as well start out with a little bit of the PSA about the breakers. You mentioned the first one, and just to say where we're at right now. The first level of it is the 5%, which applies to the after-hours trading in the futures market, and we hit that pretty quick after the open last night. I was watching it.
It happened fast.
It happened fast, and then it was jammed up there. And then once trading opens, there's circuit breakers at 7% down, which we hit.
We hit that one.
You get 15 minutes.
30 seconds in.
Yeah, 30 seconds in to take a jog or do whatever you're going to do, take a few desk laps. The next one is 13% down, which is another 15 minutes. You can take a second jog.
Where does it, S&P's put us at 13% down? That's 25.81?
Yeah, I believe that's correct.
So 25.81, if we get down there, make sure you're out of your positions. Yeah, just get out, be flat.
Yeah. But there's one more level, the 20% level, and it's for the day.
Right.
Okay, so my understanding is we've never actually hit those second two. The last time we hit the 7% circuit breaker was back during the financial crisis. So it's been what now, 12 years since we've seen a 7% move like that?
I believe it came on the day that Lehman Brothers folded.
I think it did. I think it happened right away. We went limit down. But something to keep in mind, in 2010, they adjusted how their limit system works. So this is the first time it's ever happened the way it did today. And I think at the end of the day, something that I can't stress enough is, yes, this is scary times to be trading. There's an advantage for us as retail traders. We're not stuck in these massive positions. The amount of people, firms that I've heard about over the last week that have completely blown out, that have been in this industry for 30, 40, 50 years. Quite a few last week. I know a bunch of guys I used to work with. They're done. Their firms have shut down. They took too big of losses. Hurts when you're short premium and the bond market rallies like crazy. But at the end of the day, for us, we have the advantage of being able to sit out, wait for our opportunities, be really, really smart and safe in this.
And trade small.
And trade tiny. And then on top of that, I also think what you have to be keeping in mind, during the financial crisis, we had a bubble burst. We had a rough economy. Right now, look at Friday's job reports numbers. I mean, those were spectacular. We're still showing great numbers. So I think once we can get past this coronavirus stuff, once we can start to see it downturn, this market's going to start to rebound. And I think when we get there, the rebound will be fast. So for me, the panic isn't really around the economy and the world falling apart. It's more around, okay, we're fearful for right now for coronavirus.
I think part of that fear that we're getting from the coronavirus is, what is it going to do to the supply chain? What is it eventually going to do to the economy? And that's
absolutely,
that's an unknown. And I think the markets are very irrational right now, and obviously they're out of balance, and nobody knows what's going to happen. And I think that's a little bit, as I said, irrational. And it's not the markets that are irrational; it's the people trading them. So I'm with Dan. I think eventually cooler heads will prevail.
Absolutely.
What goes up must come down. What goes down must eventually come back up.
That's the stock market.
My dad always said the market always looks the best at the top and the worst at the bottom. So we're trying to find that bottom now, and there's still a lot of unknowns, still a lot of uncertainties. Markets don't like that, and so we just have to make sure and either watch from the sidelines or put together a very, very cautious and patient trading strategy.
Yeah, speaking of which, Dante says today's the 11th anniversary of the bull market, and what an anniversary it is! They're just gonna end it, I guess.
Well, I guess the honeymoon's over.
Yeah,
right.
Interestingly enough, we kissed a 20% down move from the all-time high to the low today.
Yeah.
Absolutely.
It was right at that 20% retracement mark. And
Yeah.
bounced right off of it.
Yep.
Congratulations to Level 2 for catching some of that move off the second lock. To answer what Dante is saying about he doesn't think we're going to know the effects on the economy until after Q1. So I'll play a slight counterpoint. I think what Dan's saying is that maybe, panic's never a good reaction to anything necessarily.
Yep.
And so I'll take the other side of what Dan said and some things I'd be watching out for, especially short term. You were mentioning how you knew some people at a firm that got blown out.
Right.
This week, I'd be very interested to see, especially with the consummate face-ripping move in oil and in bonds, if some funds aren't hurting quite badly.
Oh, quite a
So
few.
similar to in 2008, we won't know for a little bit what that damage is. So I hope there's nothing.
Oh, absolutely. I think it's going to take some time. I think we've got a long road ahead of us. I'm taking that macro viewpoint of it's going to be maybe this summer we'll start to see things. I think we have a long road ahead of us before we get to that turnaround
This is going to
point.
be the new normal for a little bit.
I could not agree more.
Right.
Yeah, I'm going to be doing some traveling soon, not to any of the hot zones, but my wife just got back on a flight this morning, said it was empty.
I believe
There's definitely some things in the real world that are happening now that are going to have an effect, that are going to be a drag. But the question is this a short-term, a medium-term thing, or something greater than that? So I think it's just important to be flexible, be nimble, and to not get in over your head.
Don't marry a bias.
When we see quarter one revenues from some big tech companies, we're going to know what the real fallout actually is. We're going to know how bad manufacturing slowdowns were.
For
We're
sure.
going to know how bad trade restrictions and travel restrictions, how bad that toll really took on the economy. I'd say by the end of the month, we're going to have a lot clearer picture of what's actually going on.
Absolutely. I think those revenue and earnings and that stuff starts coming out, that's going to tell a whole different story.
Now, one of the things I wanted to kind of touch on is, there are a lot of questions as to, why is the market frozen? Why is the market frozen? Mm-hmm. And it's not actually frozen. When we were down the limit, that 5% limit in the overnight, a lot of people were thinking, something's wrong with my dome. Why isn't the market moving? Why can't I sell one? It's because, you're going to, when the market is limit down, you're able to offer at that price, but it doesn't mean somebody's going to come along and buy it, right?
Absolutely.
So you're still able to trade. It's just a matter of finding the other side. So on the open this morning, we had about 13,000 on the offer at that 5% breaker level. And when the market opened at 8:30, you saw the market kind of tank off of that. So a lot of those offers were longs that were just trying to get out, that weren't able to at that 5% level. They had to let the market open up and find buyers down below that in order to get out of that. So, when you're trading this, you have to really think about if you're going to take that long down near that limit, because you may get stuck in it.
And that being said, a useful tool, and correct me if I'm wrong at this, because as I said, I've never traded through one of these things because it hasn't happened since 2008. But my understanding is that the ETFs, for instance, do not have breakers. So if you are, we're locked out in the futures, you can kind of see where things might be trading when they reopen. And I think that's
Absolutely.
definitely a useful thing to take a look at.
They were showing it this morning. They were down at about 27.62, so just a few handles above where that limit down would be at the 7% They were down there, and if you started watching the pre-open, let's just say stick with the S&P here. If you watch that pre-open, you could see the orders started working their way down. I think we opened up right at right a half a handle up,
Right.
And traded for a little bit before it locked us out again. And I think something important to think about here. Our original lockout this morning, we opened up 2% below that, and so right now, if you're one of our funded traders, you probably know we're suspended trading in the live account strictly because we want you to trade safe. That's our mission here, and safely engage in the financial markets. And when you cannot get out of your positions, that's not safely trading. And so we don't want to see any traders getting hurt because they ended up having to take a 2% hit strictly because they couldn't get out of that position. And I think that's something for anyone out there. If you're in a simulated account, if you're trading your own accounts, if you're in the trading combine, there's that kind of risk on this table right now, and you have to be careful with that.
Yeah, you need a lot of cushion to trade markets like this, and more than you think you need. I saw one of the brokers increase their day margins today. They doubled them.
I think CME is having people.
Yeah.
Well, that gives you an idea of just how intense these moves are. But truthfully, whether it's goes from 400 to 800 or whatever, that's nothing compared to like how quickly in this market can you lose $800?
Well, when you think about that, the clearing firms, brokerages, even exchanges are raising margins. Do you think that's to protect you? No. That's to protect themselves. In having us, say, hey, let's just back off of the funded trading for a little while, I think that's us being a good steward to you. We want to make sure that you have the opportunity to continue to trade for a long time. And again, these markets are vicious.
Absolutely. I'd hate to see someone long on a limit down, and then they were fine in their funded account. Maybe they were up some money. That market pushes all the way down that 2%. That's a big, hefty chunk of change there. If you had one or two on, you could be at your limits and lose that account way too quickly.
100%. Like we said in our morning forecast video, if you have not seen these types of markets before, do not be trading them. This is not the type of environment to start picking bottoms in. You can get run over so quick, and it can just turn into a disaster.
Dante says, how do you guys say it? AMP or AMP? Like
AMP.
Sorry, I never traded through them. Double
trade.
margins. That's who I was discussing. He says for today or for a while. I mean, at least for today, I would presume they keep it out for a while because we've had so many days in a row with these 2+% moves every day, 4% one way, 5% the other, and this uncertainty is not going to get cured right now.
No,
right.
It's going to take time.
Oh, and by the way, crude oil's down, I think, at their highest, 31%.
That's something that I want to talk about too, is you talk about the danger of holding positions long term. And I never traded crude oil, so this is maybe something that I'm being ignorant with this thought, but I did trade bonds. And there used to always be this thing that if I was going to hold an outright position through the weekend, I always wanted to make sure that it was long bonds, because if something like an exogenous shock happened, bonds were going to go up.
Right.
It was very unlikely that something was going to crush me to the downside. I would have assumed maybe the same thing. I would usually be expecting something to spike oil over the weekend, but oh, sweet Jesus.
OPEC, Russia, man, oh man, can they sustain these prices?
Yeah, they got a little fight going on.
$10 down on the open.
I'll tell you what, this last night at 5 o'clock, I was sitting at my parents' house and I was having dinner with them, and my dad's in his office, and he's like, Danny, get in here, you gotta see this. And I come running in, and he's just sitting there, hands, just couldn't believe watching what these markets were doing. Crude oil was the one in particular that we were looking at. Just because we're seeing crude oil at $33, yes, the product there is cheap. It's still $10 a tick every contract you have on. And that's what we have to keep in mind. So just because prices are down per barrel, we're still, when these moves happen, when you see 4%, 10%, 20%, 25%, if you're on the wrong side of that, gosh, it's tough.
It's huge for a leverage move.
Absolutely. By the way, I think we got to give a shout out to Instagram. I think this is the first time we're ever live on Instagram.
Hey there, Annie.
Hey guys.
So hopefully everyone over there, if you guys are watching, like she's dropping some comments and questions and thoughts there.
I do have one question.
Let's hear it.
So someone's asking, should we be looking for smaller take profit levels?
Smaller tick profit levels?
Take profit.
Take profits.
Oh.
In the equities or in crude oil, these markets are extremely out of balance. If you do manage to get a good position on, it's probably going to be worth more. So you always want to be reasonable. You start getting dollar signs in your eyes, that can usually be a signal, okay, maybe it's time I should
Yeah,
get
get
out of
out.
this trade. But these volatile markets do offer bigger opportunities. Just keep that in mind.
Yes, they definitely do. And the one thing you got to keep in mind too is the downside. How does that go against you quickly? Just accept that you're wrong, but also know, even if you were in at a great level, your risk is still going to be up there for that market to eventually possibly go in your way. It can take that hit pretty quickly. It can go against you $500-600 on a one lot like that,
Yeah.
and you got to really be, you got to have the intestinal
With
fortitude to handle
with
that.
the greater opportunity comes greater
I
risk.
was Trader PD saying, like, was trading energies and oil, and folks were laughing that I was wearing, it says dippers, but I think he means diapers. Now they all wear them. Like, yeah, whatever works for you, man. I'm just going to stay flat and not wear one. But
5-gallon bucket underneath the desk.
I mean, I guess most of our guys aren't in an office trading, so,
Right.
do whatever works for you.
There you go.
I don't know how we're going to top that.
Oh, I got a pit story, but we'll do that later.
We'll do the pit stories later. But did anyone else besides the obviously equities or things that, that's the most popular product that our traders are trading, that and crude oil were huge moves. The
Bonds 7.5 handles off their overnight high
Everything
after the
got crushed.
open.
Grains, cattle, hogs.
The Nikkei was down 9% at one point. Volatility does not apply to just one product right now. It's
No.
applying to everything.
Yeah.
The dollar I saw was down. Everything you have to just be cautious and careful on.
Well, here's a wild point of speculation here. Did you ever think you'd see the 10-year yield this low, this quickly? And what do you guys think about the possibility?
Negative.
Is he going to say it? Oh, he said it.
Once I say it, I might conjure it to existence.
I got a text.
Negative interest rates.
So I got a text message last night at about 5:05 from a guy who you used to see here all the time, Mark Meadows. And the first thing he says is, "Are 10 years going negative in the next couple months?" They did bounce a decent amount at one point here today. They were down at 0.3. I think they bounced to 0.5.
Economists have been calling for 0% rates by the end of the year. I think we're going to get 0 in the next couple months, and then it's negative after that.
I think so too. I think we could see it this summer. I think this summer, I think we're setting up right now into a wild summer. I know we've been saying that for like the last 3 years. We're leading into another wild summer, but then you can throw elections on top of this. You're going to throw coronavirus is still going to be prevalent. Then you throw that on top of this. We'll see what happens with the
Lots
Olympics.
of uncertainty.
Yeah, tons of uncertainty out there. That is for sure. Dante says, let the big boys play it out because they're going for each other's throat. I think that the biggest problem with trading a market like this is just you're not in the know of things that could happen. Like firms will be blowing out and it'll spike certain products for no apparent
Absolutely.
reason. It's a very tough market to be in.
Looks like we got a question over here from Annie.
Someone wants to know a basic explanation of what negative interest rates mean.
It means we're paying the government to lend them money. Simply put,
I could feel that a little bit.
Yeah.
So it's really an artifact of like the way that bonds work. Obviously, the government's not offering, the U.S. government's not offering negative rates. They have some coupon on the bonds, but they're traded on the open market, and as price goes up and up and up in the bonds, you get closer to 0%, and if they went high enough, they would be negative yielding bonds.
yeah.
There's a lot of questions out there. So there's already a lot of it out there, especially in Europe. Their government stuff is negative rates. I think that the price gets bid up a lot of ways because there are a lot of pensions and macro funds. Meadows talked about this a
Yeah,
lot.
so
but-
there's a lot of funds out there that they have to be a certain percentage in the treasury markets, and that's what's going to continue buying in those markets, continue movement in those markets. And then also keeping in mind a lot of traders that are trading in the treasuries, they're also there's a lot of options traders there, and those option traders are trading based off of volatility. So they're hedging positions based off of the futures. So they're carrying 5, 10, 15,000 contract positions just to keep their options hedged, and they don't really care what the interest or what the yield is on that. They don't really care because it's just to cover and keep themselves delta neutral when it comes to the options.
Yeah, level 2 says banks are forced to hold collateral by law. I think another thing with the negative interest rates, if you're talking about what that means kind of fundamentally, the jury's still out a little bit. Some people want to see those negative rates. It's unclear what the long-term effect would be of having negative rates like that. I know it's some Swiss accounts, for instance, already for their high worth individuals are making them pay fees now on their accounts because they can't afford just to hold all this negative yielding debt or negative interest rates. So the jury is a little bit out. It's sort of freeform jazz, as I would call it. I don't like it.
You're gonna get the Miles Davis bonds.
Yeah,
Right.
when we start calling get some of those jazz bonds on the long end,
Right.
I mean, intuitively, none of it feels like it makes any sense. Like, why would I ever buy a 30-year instrument that is giving me less than 1% of yield a year?
Right.
You, as a
Basically-
normal consumer, you don't want to do that.
Basically negative.
Right.
Yeah, so we're basically already there. Dance, we're about to find out. So a lot of options activity and stuff seems to think that it may go negative sometimes.
Absolutely. I think that's the common thought out there. We'll see what happens. Obviously, time will tell. Things can change, as we've seen here this last month or so. Things can happen drastically. and
Speaking of
fast.
which, we don't have a chart in front of us. So if one of you guys out there, what's the S&P printing right now? I'm just curious.
I think I'm gonna say 2811. We'll see.
He's taking it easy. He's going to talk to his therapist. Yeah, Dante, go do that. Get your head right.
Right.
Then get your wallet right. It's all good.
Yeah, absolutely.
Yeah, 28.25. Thank you, Matt.
Oh, nice. Okay.
All right, so we're still bouncing
pop,
off.
yeah.
A little bit. Ooh, now it's 28.26. Thank you, Gio.
Ooh, just made a quick handle there.
You're typing pretty quick there to keep up with that.
Well, is there anything else that we wanted to delve in here, or do you want to just?
No, I think at the end of the day, you guys just got to be safe, be smart, cut those losses as quickly as possible if you're trading. If you're not trading, that's not a bad idea. Some days the best thing to do is just stay out of the market because we don't know where this thing can go today.
Yeah. If you don't have a strategy for this, then don't get involved, right? It's very, very difficult. Even professionals have a hard time. You were talking about actual trading companies blowing out. That's how difficult it is.
Absolutely. It sounds like we have one last question over here on Instagram.
Yep, one last one. Someone wants to know, has this ever happened before?
Yes.
Yeah.
So
was
the 7% breaker got hit in 2008.
2008.
The flash crash did not trigger it. Does anyone know, has the 5% been hit in after hours?
So the
since then?
2010, they had the flash crash. That's what caused it. It failed to work in 2010. So that's when they updated to this new system, how they have it right now.
And the 5% was hit once the night Trump was elected.
November 2016.
Oh, level 2 mentioned that.
Yep.
Yeah. So that's the only time it's done that. And the
In recent times.
in recent times, the most the market's ever dropped in a day, Hoag remembers well,
What?
87. It dropped.
Well, I'm thinking the Dow, like in actual numbers, like 504, but it was
But
like
the percentage, like
Well, which is-
20 something.
Which is amazing. 504 points.
right,
We're down. We hit 2,000 down today,
Today.
and we were at 7%.
right. I think it was like almost like 40% at one point.
Well, what was the Great Depression? That was another drastic percentage number down as well. That one I don't know off the top of my head. I have it written down somewhere. I'd have to look at it. It's happened before.
It was so painful. I put it out of my mind.
Yeah.
Yeah.
Level 2 says, Dan, are negative interest a way to force investors into risk assets? They're a way. Yeah, in some ways.
Yeah, I guess you
they're a way to
could.
force some people. I don't know if it's us necessarily, but yeah. Ideally, you're not going to be holding a lot of cash savings if you're getting a negative interest rate.
Right. You're going to see a lot of people trying to push the markets down, push them down to bring the rates back up because at the end of the day, like we said, there are certain funds that need to be in these positions.
Yeah, so just a final pulse check. As you said, 7% was last hit in 2008. the entire move in the Great Recession, I think, was about 56% from peak to trough, and that occurred over, I think, March 2009 was when it hit its low.
29.
What?
1929.
Oh, 1929.
Yeah.
No, it's about the Great Recession.
Oh, okay, 2009. Oh, okay, got it.
Oh no, I'm not having
Right.
a stroke right now. Yeah. So that was about 56%. I'm not sure offhand about the Great Depression. Obviously, things were a lot different then as far
Sure.
as markets and things like that. So it could have a long way to go, but hey, we're all here after that.
Right.
So eventually,
Exactly.
these things have a way to work themselves out. I'm not ready to do the old, as I call it, the dried beans and ammo run. But I think we just gotta see how this plays out.
Absolutely.
Hoag mentioned having a strategy. Honestly, I don't think there is a strategy for this. I mean, if you weren't in the market, if you weren't short on Friday, then you shouldn't be in there right now. I mean, if you catch yourself trading your P&L, like many of us have done before, just get out. And
Who, me? Never.
Trader PD last thing says, is arbitrage a good idea then? Yeah, if you can do it. But
Right.
I don't think that I don't know what your setup is. I mean, you could be the head of Goldman Sachs or something, but it's very unlikely that.
You gotta be fast.
Yeah, they have the microwave lines and stuff. Any arbitrage opportunity falls out pretty quick.
Yeah.
It's a recipe for getting missed when you're trying to hedge it. You'll see an arbitrage opportunity, and then you'll just instantly lose money.
Yep.
Which is a form of arbitrage for someone else.
Right.
Yeah.
Right. Yeah, you just kind of lock in losses when you do that.
Yeah, you
most
sure
of the
do.
time.
Yeah.
Awesome.
All right. Well,
Don't forget, guys, we'll be back here at 3 o'clock for the recap. Let's see what happens by then.
Anything can.
anything
kidding.
can. Enjoy. Nope, in the basement? Yeah. Do it. Basement's the best place to trade, man. So we'll be back at 3. In the meantime, everyone stay safe out there. Thanks for checking in. Thanks for asking your questions. That makes everything nice.
Absolutely.
Absolutely. Thanks again for watching. Make sure you wash your hands, say a prayer, and we'll see you at the recap at 3 o'clock.
All right. Trade well. A lot of people now.
That was great. We had 377 viewers.
Oh, cool.
Wow.
We have
Yeah.
40 something.